This is Janus Dispatch, Architecture over Narrative. Today's topic, the third party, and what it means that Washington bought yen with euros. At 11:33 last Friday morning, a Reuters photographer at Camp David got a shot of the Treasury Secretary's notepad. Among the items in the flat register of a man listing errands to do by Japanese yen, $5 to $10 billion. 5 hours later, it was done. Between 4:14 and 5 o'clock in the afternoon in New York, the dollar fell against the yen from 158.9 to 157.6 and closed the week at 157.4, the strongest the yen had been since early May. Reporting has the New York Fed executing on the Treasury's behalf through Goldman Sachs and Morgan Stanley. It was the first time the United States had bought yen since June 1998. The 2011 operation everyone is citing this weekend ran the other way. Washington sold yen then to weaken a currency the earthquake had made too strong. 28 years is the correct interval, and the direction is the point. The interesting part is not that it happened. It is what was spent. The Treasury did not sell dollars to buy yen, it sold euros. The plumbing answer, which is the real one. Most commentary read the choice as politics. Selling dollars would weaken the dollar, and the administration cannot be seen weakening the dollar. That explanation collapses on contact with the administration's stated preference, which is for a weaker dollar, and has been for a year. The actual reason is duller and more revealing. The Exchange Stabilization Fund holds foreign currency. To buy yen, it swaps one reserve asset for another, and no new dollars come into existence. Selling dollars would mean creating them. That is a monetary act, and it would be read as one. So the operation was an asset swap, neutral for the American money supply, invisible on the Fed's balance sheet, and paid for out of a finite stock of euros. Finite is the word that matters, and the number is smaller than the language around it suggests. At the end of March, the fund held about $13.1 billion worth of euros and about $5.9 billion in yen. Roughly $19 billion in total foreign currency against a headline fund size of $220 billion that is almost entirely special drawing rights and Treasury paper. Against that drawer, the figure on the notepad is not a rounding error. It is between 1/3 and 3/4 of the euro position. There is a second drawer. The Fed's own account holds a near mirror of the fund's reserves, another $13 billion or so in euros. And in 1998, the two institutions split the operation down the middle. Reaching for that half doubles the ammunition and changes what the operation is. A Treasury drawing on its own fund is fiscal housekeeping. A Fed committing its balance sheet to an exchange rate objective is monetary policy with a different name. And the euro funding was chosen precisely to avoid that reading, which leaves 3 options at the bottom of the drawer. Buy the euros back at whatever price the market offers by then. Create dollars and admit that this was a monetary operation all along. Or use the mechanism almost nobody remembers: warehousing. Under a standing authorization from the Federal Open Market Committee, the fund can sell its foreign currency to the Fed for newly created dollars and agree to buy it back later at the same rate. It has not been drawn since 1992. It has also never been withdrawn. One caveat belongs here rather than in a footnote. The euro funding detail comes from a single reporting chain. Treasury declined to comment. The New York Fed has published nothing, and the quarterly report that would document the operation formally is not due until November. Everything that follows holds, if the reporting holds. The intervention sits inside the loop. The chain everyone now recites runs like this. The yen falls. Japan sells treasuries to raise the dollars it needs to defend the yen. Treasury supply rises, yields rise, and the 30-year closed Friday at 5.28%, a level last seen in 2007. Japan holds $1.14 trillion of American government debt, more than any other foreign holder. The selling is not theoretical either. That 1.14 trillion is the May figure. In February, it was around 1.24 trillion. Whatever else was happening in those 3 months, $100 billion of Japanese-held treasuries left the book. Thursday's Japanese operation was the largest single day in that history, somewhere between 8.2 and 8.45 trillion yen, $53 to $59 billion, depending on which desk did the arithmetic. Every one of those figures is a back calculation from the Bank of Japan's money market data. The Ministry of Finance has confirmed nothing, publishes monthly totals a month in arrears, and does not break out individual days until roughly a quarter later. The yen had touched 163.99 before it, its weakest against the dollar since 1986. What the recitation misses is that the fix feeds the problem. The mechanical impulse of Friday's operation runs against its own objective. The dollar index is 57.6% euro and 13.6% yen. Sell euros and buy yen in equal measure, and the index rises, because the currency being sold carries 4 times the weight of the currency being bought. The operation designed to push the dollar down against one currency pushes it up against the basket. And a stronger dollar widens the differential that is pulling the yen apart in the first place. Now look at what the week actually printed. The euro rose against the dollar from 1.1367 on Monday to 1.1485 on Friday. The yen rose. The dollar index fell. The mechanical impulse I have just described is nowhere in the data. That is worth sitting with rather than explaining away. $5 to $10 billion is a serious number against a 19 billion reserve drawer, and an unserious one against a foreign exchange market that turns over trillions in a day. The yen leg moved a price in a thin Friday evening for about 45 minutes. The euro leg moved nothing at all. An operation that changes a price is a transaction. An operation that does not is a message. Friday was a message, and its content was this. The United States now treats the yen as its own problem. That message will be tested, and the testing will happen in the pair, not in the press release. But note what the invisibility does to the accounting. The euros were spent. The stock is smaller. Nothing in any price told anyone that this had happened. It is what happens when you fight a rate differential with a spot transaction. The Federal Reserve is holding at 3.5% to 3.75%, with 3 governors dissenting in favor of a hike. The Bank of Japan is at 1% and held there on Friday, upgrading its growth forecast while trimming its headline inflation forecast. The gap is roughly 2.5 points. It compounds daily, and it is not obviously about to close from either end. The intervention is a stock of euros that runs out. Europe was not asked and has not objected. The obvious complaint writes itself. The United States took a Japanese problem, converted it into a European one, and did not consult the European Party. The complaint is usually made by invoking a G7 rule about intervening in third currencies. That rule is thinner than the invoking implies. The G7 statement of February 2013 commits its signatories to market-determined exchange rates and to consulting closely on currency markets. It says nothing specific about a third party's currency. What was breached is a convention, not a text. And conventions have no enforcement mechanism beyond the willingness of the injured party to be visibly injured. As of Sunday, no European official has said anything. The comfortable reading of that silence is that Europe does not mind, because a weaker euro helps exporters. That reading is a decade out of date. The euro has not been weak. It is up around 4% against the dollar over the year. It rose during the week of the intervention, and the euro area's goods trade balance flipped to a 7.8 billion euro deficit in May, against a 15 billion surplus in the same month a year earlier. A 23 billion swing in 12 months, driven by the energy bill. The export surplus that a cheap currency was supposed to support is not currently there to support. The less comfortable reading is that Europe is silent because the operation was invisible, and objecting to something the market did not notice makes the objector look small. A protest requires a price move to point at. There wasn't one. What was actually taken from Europe was not an exchange rate, but a small piece of optionality. The assumption that its currency is not an instrument in someone else's toolkit. And optionality has no ticker. The response, if there is one, will be a formal protest rather than a portfolio decision. The euro system's dollar reserves are small relative to the market it would have to move, and the retaliation available is worse than the injury. What Europe pays twice for. The exported cost is real. It is simply not the exchange rate, and the currency channel is the least of it. Europe's problem is that its inputs are priced in a currency it does not issue, in markets it does not set, at levels its competitors do not face. Dutch gas closed July around $19.70 per million British thermal units against Henry Hub at $2.65, a factor of 7.5. The International Energy Agency puts European industrial electricity at roughly double the American level. Since January, with the Iran conflict unresolved, gas is up about 80% and oil about 66%. The European Union's energy import dependency was 57% in 2024, essentially where it stood before the invasion of Ukraine. And the 2025 import bill still ran to 337 billion euros, with liquefied gas up 35% in value on the year. That is the first payment, and it is the one everyone counts. The second is less visible and considerably larger. Between April and November of last year, foreign holdings of U.S. Treasuries rose by about $301 billion. European investors supplied roughly $240 billion of it, 4/5 of all foreign buying. European savings are financing the American deficit at a moment when European industry is not being financed at all. The continent that pays the dollar price for its energy also lends the issuer of that dollar the money to run its fiscal position. Which returns us to the question the auction always asks. Washington needs foreign buyers to keep showing up. They are showing up. They are European. And Washington has just spent a piece of their currency without asking. There is a hopeful version of the first payment, and it deserves a hearing before it is dismissed. High input prices force efficiency. Efficiency compounds into innovation. Innovation ends the dependency. Japan after 1973 is the standing example. It is a real mechanism, and it has worked before. It is not working here. The European Central Bank's own firm-level work finds that a 1% energy price shock cuts corporate capital expenditure by 4.1% within a year, and research spending by about 0.85%. With the deepest cuts among financially constrained firms in exactly the energy-intensive sectors that would have to do the innovating. The International Energy Agency's decomposition of Europe's record 2022 gas demand. Fall attributes roughly a quarter to genuine structural efficiency, a third to a mild winter, and the balance to industrial curtailment and fuel switching. What looked like adaptation was substantially subtraction. Of the Draghi report's 383 recommendations, 15.1% were fully implemented as of January. Meanwhile, the physical capital votes. German industry surveys have the share of large industrial firms considering or executing relocation running near 60% this June, against 21% of all industrial firms in 2022, with about a third of the large ones already moving. ArcelorMittal canceled its 2 German green steel projects and returned 1.3 billion euros of subsidy, rather than build at German power prices, redirecting the money to Dunkirk and French nuclear output. BASF now allocates 47% of its capital program to Asia-Pacific and 36% to Europe. The induced innovation story assumes the capital stays long enough to innovate. Research cycles run in years, and citing decisions run in quarters, and when the two disagree, the faster one wins. There is a serious argument on the other side, and it should be stated at its strongest. The median European manufacturer cut gas use by about 15% without losing output, because hedging meant the median firm's delivered price rose 29%, while wholesale prices rose 240%. Wind and solar together outgenerated fossil fuels in European electricity for the first time last year. And the sectors under existential pressure, chemicals, metals, cement, paper, account for around 2% of European output and employment, which makes their relocation arguably a rational reallocation rather than an emergency. That argument holds if basic chemicals are a product. It fails if they are an input. A continent can export the making of ammonia and keep the making of cars only until it discovers what ammonia was upstream of. And the exit is priced in dollars too. The hardware that would end the dependency, modules, cells, grid equipment, comes largely from China and is overwhelmingly invoiced in dollars, since the renminbi still carries under 2% of world trade invoicing. A weaker euro would raise the euro cost of the very investment meant to make the euro cost of energy stop mattering. That channel is dormant while the euro is firm. It is not closed, which is the whole point of the week. Japan has spent 2 decades treating a weak currency as debt relief, and at 164, it found the boundary. Past some level, the cheap currency costs more in imported energy than it forgives in real debt. Thursday was the sound of that boundary being hit. Europe has not hit it, because its currency has not fallen. It has the same exposure and has simply not been tested. 2 out of 3. Underneath the week's mechanics is an arrangement that does not close. Washington needs 3 things at the same time and can have any 2 of them. The first is a weaker dollar, for trade and for reshoring. The administration has been saying so for a year and has not stopped. The second is low yields. The headline debt is $39.8 trillion, but $7.8 trillion of that sits inside the government's own trust funds, as non-tradable special issues that never come to auction and never reprice. The number that matters here is the marketable stock, $31.7 trillion. A third of it matures inside 12 months, 2/3 inside 5 years. And the average coupon on it is 3.4% against a 30-year now printing above 5. Every roll at current levels raises the interest bill. The third is foreign buyers who keep showing up at auction. We have already met them. 4/5 of last year's increase in foreign treasury holdings came out of Europe. Now put them together. A weaker dollar hands foreign holders a loss on their treasuries measured in their own money. Foreign holders who take losses become sellers, and sellers raise yields. Take the weak dollar and keep the foreign buyers, and the yields go. Keep the low yields and the foreign buyers, and the dollar has to stay strong. Take the weak dollar and the low yields, and somebody other than a foreigner has to hold $31.7 trillion of paper. Whichever 2 you choose, the third breaks. The strongest defense of the second leg is that it binds less tightly than it looks. The weighted average maturity, at just under 6 years, sits near a 26-year high. Treasury has termed out more than at any point since the late 90s, not less. It is a real point, and it does not survive the arithmetic. A third of the stock rolling inside a year, into rates 2 points above what it currently pays, raises the interest bill mechanically and monthly, whatever the average says. When a government cannot choose, it stops asking. The remaining option is to arrange for the debt to be held anyway. Relief on bank leverage ratios, so balance sheets can absorb more. Mandates that push pensions and insurers toward the long end. Rules that manufacture a new class of holder. Facilities that make holding treasuries cheaper than selling them. The first of these is already law. The recalibrated supplementary leverage ratio was finalized in December and took effect on the 1st of April, and the regulator's own reasoning cited the disincentive for banks to hold treasuries. That fight is over, and the outcome was capacity. The second is the reserve rules written into stablecoin legislation, which convert private demand for digital dollars into standing demand for Treasury bills, held by an issuer no government can instruct to sell. It is a larger fight than its coverage suggests. It also buys the front end and no duration, which is the wrong end of this particular problem. The third is the FEMA repo facility, and it is worth naming rather than gesturing at, because naming it makes the claim checkable. The Fed made it permanent in July 2021. It lets foreign central banks borrow dollars against their Treasury holdings instead of liquidating them, at $60 billion per counterparty, priced off the standing repo rate. Japan has access. Used at scale, it takes $1 trillion of potential supply off the market without a single auction being touched and without a single rate being set. As of the week ended the 29th of July, the line on the Fed's weekly balance sheet that would show it, repurchase agreements with foreign official accounts, reads 0. It has read 0 for months. That 0 is the useful thing in this essay. It is a number anyone can look up every Thursday afternoon, and it is currently telling you that the mechanism I am describing has not been used. If the argument here is right, it stops reading 0. Not with a program name, not with a press conference. A line item in a weekly balance sheet release, growing quietly. It converts sovereign bonds into dollars without selling them. Whatever else that is, it is not tightening. What everybody is actually trying to do. Step back from the week, and the pattern is older than the week. Japan has spent 2 decades trying to inflate away a debt stock it cannot grow out of, and the weak yen is the instrument. The United States would like the same relief, and says so. Europe would take it if offered, and is being offered it now, sideways. Every one of them is trying to devalue, against each other. That cannot work, and the reason is arithmetic rather than policy. Currencies are quoted in pairs. If all of them fall, none of them falls. The exchange rate cannot record a general debasement because it is a ratio, and the ratio is unchanged when both terms move together, which is why the dollar index is the wrong instrument for the question people are asking of it. It is a ratio of 2 things that are both losing purchasing power, and it will sit near 100 while both of them lose it. A currency race to the bottom looks, on that chart, like nothing happening at all. The same blindness that hid Friday's operation hides the thing Friday was a symptom of. The only place a general debasement can register is against something no one can issue: land. Gold, which broke back above $4,100 an ounce on Friday, and is up 1/4 over the year, without anyone claiming credit. Possibly a small number of hard-capped digital assets, though that claim has been made too loudly for too long by people who would benefit from it. And it remains unproven, in a way the first 2 are not. The measurement problem. None of this tells you when. That is the honest end of the argument, and the part most writing on the subject skips. Direction is easier than timing. And a thesis that is right about direction and wrong about timing is indistinguishable for anyone who has to live through it, from a thesis that is simply wrong. Positions are not held by the ensemble. They are held by people with rent to pay. What the week did provide is a marker, and a marker is worth more than a forecast. A 30-year yield at 5.28% against headline inflation of 3.5% and core at 2.6% is a positive, real long rate. That is a bond market successfully charging for duration, which is the system working. Debasement begins at the moment the state decides it can no longer pay that price and arranges not to. Caps, purchases, mandates, repos, whatever the instrument. The phase change is not the yield going up. It is the response to the yield going up. Watch for the response. It will not be announced as debasement. It will be announced as stability. And on the evidence of Friday, It will not be visible in the price of anything at the moment it happens. That was Janus Dispatch. Sources, charts, and disclosure are in the published post. If this dispatch sharpened your read, subscribe. Janus Dispatch is at janusthewatcher.substack.com. The long arguments are in the books. The transition sequence, 2 volumes, 1 thesis. The ground is shifting. Book 1, The Proto-Post-National Age. Book 2, The Frame, both available on Amazon, paperback, and Kindle. The dispatches connect them. The books carry the weight. Architecture over narrative.